Many of us grow up hearing that debt will end your life, or debt is modern slavery. These ideas aren't entirely wrong, especially when you're overwhelmed with financial obligations. Once you're smashed by the debt, your sense of control begins to fade. While you work tirelessly to pay what you owe, your debt doesn't stand still. It compounds. Because lenders never offer money for free, interest piles up day after day. And yet, in sharp contrast to these cautionary views, debt has become a fundamental part of the American economy. In fact, U.S. consumer debt has skyrocketed to nearly $15 trillion, bringing the average household debt to over $5,300. The country's GDP hovers around $21 trillion, suggesting that much of the economy itself is built on borrowed money.
We often hear that debt is a trap, and it absolutely can be, but it's also a tool. A hammer can build a house or break a window. It all depends on who's holding it.
But here's where things take a surprising turn. Debt isn't always bad. That might sound like an unpopular opinion, especially if you're someone struggling with credit cards, student loans, or car payments. You might be thinking, it'll take me half a lifetime to pay these off. How could this possibly be a good thing? To understand that, we need to shift our perspective and explore how the wealthy leverage debt, not just to survive, but to multiply their wealth. It may seem counterintuitive, but debt can actually be a powerful financial tool if used wisely.
The wealthy aren't necessarily smarter than the average person, but they understand how the system works. If you shift your mindset, build a strong credit history, and learn how to manage debt.
Let's break down how the wealthy use debt to grow richer, while most people are burdened by it. 1. Strategic borrowing to grow businesses. Debt plays a foundational role in global trade, and many entrepreneurs still rely on it to launch or scale their operations. Now, taking out a loan to start a risky business is often discouraged, and for good reason. But in certain traditional industries, borrowing money makes perfect sense. Take a simple product like pens. Demand is consistent, competition is manageable, and margins can be healthy if executed right.
They use debt to buy assets that grow in value, reduce taxes, and generate cash flow. Meanwhile, most people borrow money to buy liabilities, cars, gadgets, or luxury items that depreciate and generate no income.
Traditionally, you'd visit a supplier, often in China, which has become the global hub of manufacturing over the past 50 years. Today, platforms like AliExpress make this process even more accessible. But here's the trick. You don't need to pay for the inventory up front. Many Chinese manufacturers are willing to supply goods on credit, as long as you've built a foundation of trust. That means you could sell the pens first, earn revenue, and then pay the factory later. It's a win-win setup. The factory offloads products, and you get to run a business without heavy upfront investment. You're essentially saying to the manufacturer, you know how to make it. Let me help you sell it. If I can sell it for more than X, I keep the difference.
This method doesn't lock up your own money, which is why sales skills are some of the most valuable in business. When executed correctly, this kind of debt isn't a burden, it's leverage.
2. Refinancing real estate. Debt with benefits, if there's one type of debt that consistently creates millionaires. It's real estate. Many people don't realize that having a mortgage actually reduces your taxable income. That's one reason why wealthy individuals often maintain multiple mortgages, not because they can't afford to pay in cash, but because of the tax advantages.
Mortgage debt is often structured in ways that benefit the borrower, especially when tax codes and refinance strategies are factored in.
Imagine you've saved $200,000, a substantial sum, but not enough to buy property outright in many cities. You find a property worth $500,000, but it's in poor condition. You make a 20% down payment, $100,000, and take out a mortgage for the rest. Now, let's say you invest another $50,000 to renovate it. After the improvements, the home's value increases to $700,000. You go back to the bank to refinance based on the new valuation. The bank offers you 80% of $700,000, which equals $560,000. From that $560,000, $400,000 repays the original mortgage. $50,000 covers renovation costs. You're left with $110,000 in your pocket. You've now pulled a profit from debt, still own the property, which can be rented for passive income, and you benefit from mortgage interest deductions on your taxes.
This approach is widely used by real estate investors. It demonstrates how debt, when used strategically, can generate wealth, not destroy it.
3. Hedge funds. Profiting from downturns, hedge funds are designed by and for the wealthy. Their purpose? Make the rich even richer, often using strategies that seem counterintuitive to the average investor. While most people invest in companies they believe will succeed and grow, hedge funds often bet on failure. So, how do hedge funds use debt? Let's say you expect Toyota's stock to drop because maybe Tesla just revealed a new battery tech that's shaking up the auto world. You borrow a share of Toyota at $100 and sell it immediately. Now you owe one Toyota share, but you have $100 cash. If the stock drops to $70 as predicted, you buy it back, return it to the lender, and keep the $30 difference as profit. However, if you're wrong and the stock price rises instead of falling, you still owe that share, but now it might cost $200 to buy back. Losses are theoretically unlimited.
This is a high-risk, high-reward game. But with access to elite data and teams of analysts, hedge funds manage to make fortunes with these leverage strategies.
4. Forex. Amplifying small bets into big returns. The foreign exchange Forex market is where global currencies are traded. It's the system that allows a business in the US to pay workers in China, or a Japanese company to buy goods from Europe. Currency values constantly fluctuate based on macroeconomic policies, interest rates, and global news. If the US Federal Reserve raises interest rates, for instance, the dollar tends to strengthen. If inflation hits the Eurozone, the euro might fall. Traders make money by predicting these movements. But here's the kicker. Forex trading offers extreme leverage. For every $1 you deposit, your broker might allow you to control up to $100 worth of currency. That means with just $1,000, you could make trades as if you had $100,000. This magnifies both gains and losses.
For skilled traders, this leverage is a goldmine, but for the inexperienced, it's a quick path to ruin. Again, it all comes down to how intelligently the debt is used.
5. The credit score game. Your credit score is essentially your debt reputation. Most successful businesses rely on credit. Borrowing to fulfill large purchase orders or to expand operations is normal, even smart, if the business has proven itself. The more responsible you've been with previous loans, the more attractive you become to lenders. There are trillions of dollars in banks waiting to be lent.
In short, the financial system is built to reward borrowers who understand how to use debt as leverage. We often hear that debt is a trap, but it's also a tool. Debt is not evil. Misused debt is.